Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, it's Tuesday and we got the markets back open. Had the holiday yesterday, back open today. What's going on? Well, the Dow's down about 150. NASDAQ's kind of flat and the S&P trading right around the 4,400 level. Now, I feel that this is an extreme greed situation right now. We've had a big run up, right? And when you have extreme greed, there's another problem. You have extreme risk. This market has a lot of risk in it. People don't think so. The VIX is very low. People think there's no fear. Everyone's complacent. That's usually where the problems come up. That's just my take. Now, this market could still run. There's a big argument for that. A lot of cash is sitting on the sidelines waiting for the pullback. But if the pullback never happens, that cash will have to be reemployed into the marketplace at some point. But right now, I still contend that the market will come in. We'll see how that plays out. It's just my take. Now, since we suspended the debt ceiling, okay, remember we took away the debt ceiling, right? Now, what happened? Well, in 2 weeks' time, $450 billion of new debt. We blew right through 32 trillion. We're on our way up to 33 trillion in debt. Now, debt is what is going to eventually bring down the housing market. Now, I'm going to get to that right now. Okay, so the articles that come out over the weekends, there were a lot of articles on the housing market, and, most of them were very, very positive. Okay, all right. So here's the headline. Housing market continues to recover as buyers become more comfortable with high interest rates. Now, if you're a buyer, are you more comfortable with high interest rates? I don't think so. Look, at the interest rates are sky high, the prices are sky high. Something's wrong. It's got to revert back to the mean, and it will revert back to the mean over time. Okay, and sometimes it overshoots to the downside, just like we've overshot to the upside here. Everything's going up, everything's going higher. But anyways, this article was about Lennar. They're a home builder, right? Home builders, historically, they're about 13% of the market. But right now, they're over 30% of the market. Now, why is that? Well, because nobody's selling their house, because they're locked in at the 2.8 rate. Now, this fact that they're locked in at this 2.8 rate is what's going to bring down the housing prices. Now, I'm going to get to that. Doesn't make sense, right? They're stuck at 2.8. They're never going to sell until the day they die. They're not going to leave their house. It's theirs for 30 years or longer. They're not selling. Okay, but this is what's going to bring down the housing market. Now, why do I say that? Okay. What we have, everybody says we have a shortage of inventory. That's the main cry right now. Everywhere there's a shortage of inventory. We need another 5 million homes. The demand is there. Well, the demand is there, but not at the prices that they're building them at. Look, people cannot afford it. And affordability is a big problem right now. Only 20% of people can afford the average price home. 80% are priced out of the market. Most people could not buy their own home back. So there's an affordability thing going on right now. But the shortage of homes, I'd have to disagree with that. There's not really a shortage of homes. And I'm going to explain that in this video. Okay, let's start with that. All right, so where are all the homes? Why is there no homes for sale? Why is there a shortage? All right, do you realize there's 16 million homes that are vacant? They just sit there. They don't have anyone living in them. You see, a lot of the baby boomers, and I have them as clients because, well, I am a baby boomer and I have them as clients. They have 2 or 3 homes. They're only at one home at a time, but those other 2 homes sit vacant. Now, this is very common, right? Okay, so 16 million homes are sitting vacant. All right, and a lot of those are owned by the baby boomers. I'll be the first to admit that. Okay. All right, so now who else right now is in the market? Well, let's talk about the investor. The investor owns about 22 million homes. 22 million homes. The investor owns them. Okay, well, the investor owns these homes, but what people aren't seeing is the lag effect. The lag effect of the rate increases. Okay, so the government raised the rates for mortgages 3% to 7%. We're at about a 5% Fed funds rate, but mortgages are about 7%. So they went from 3% to 7%. What does this do? When rates go up, what does it do? Well, it makes it harder for investors to make a profit, right? Because they got to borrow money at a higher rate. Okay. And what also this article said, anyways, Redfin says that rents are coming down. Year over year, rents have dropped. This is from Redfin, not from me. It's from Redfin. And Redfin's very positive on all real estate things. But anyways, they say that the rates have dropped. So rental rates are dropping and you got the interest rates rising. So what happens to these investors? Well, it doesn't make sense for them anymore. The BlackRocks of the world have backed out of the housing market. It doesn't make sense for them to go out and borrow money and then buy a house and then rent it back to you. Rents are going down, rates have gone up. Now, when rates were low and rents were up, made a lot of sense, and this created this bubble we have. This bubble was brought on by corporations buying up all the homes and then renting them back to you. All right, this is stopping. This is stopping. It's going away. It's going away until something breaks, something adjusts. Now, when prices come down, maybe corporations come back in. When rates go back to zero, definitely corporations will come back in because they need to get a return on their money. And for the last 10 or 12 years, they couldn't get a return on their money. They could borrow all the money they want. They could get as much money as they want, but it was at 0%. But where could they make money? Well, they went into the housing market. That's what created a lot of this artificial boom we're having, and it is artificial. And I'll get into that more. Now, new home builders, like we talked about in the article, Lennar, saying that we're on this recovery pattern. They're bringing on 1.6 million units. Not Lennar, but homes under construction and coming onto the marketplace this year, about 1.6 million units. Okay, so that's a big inflow of inventory. But where's a lot of the inventory sitting right now is sitting with the baby boomers. Now, we're in retirement age. Everybody's retiring. I'm on the younger end, but the older ones have already retired. A lot of the properties I get calls upon, it's like, well, they got to sell their house because they need the money for their retirement. See, a lot of the baby boomers don't have money. They have a house, and they are very house rich. And there's about 40 million homeowners that are retired over the age of 65. So 40 million of them, and a lot of these, their only income is the Social Security they get from the government. Now, what we have is we have a lot of inflation going up. Like, is it costing more or less to heat your home this year? I paid a lot more. Is it costing more or less to fix your home when something breaks? When something breaks, it costs a lot more. So we're getting a lot of bills going up. Grocery bills going up. You got gas prices going up. Energy's going up. Everything's going up, right? But these 40 million retired people are on a fixed income. Their only income is from Social Security. And of course, they have their house. Their house is their nest egg. And that's where their wealth is tied up in. Now, a lot of these, well, some of them are going to be dying off. I go to way more funerals than I'd like to admit. But a lot of these baby boomers are starting to die off. Some of them are moving into an old folks home, right? Old folks homes are expensive. They're not cheap. They have to sell their house to move into the home, right? So that's what I get a lot of calls about right now. Baby boomers getting ready to retire need the money out of their house because they can't afford things because their only other income is Social Security, and they're running out of money, okay? And as prices continue to go up, they're going to continue to run out of money. Now, what people aren't talking about is the lag effect. There is a lag effect from where the Fed started raising at 3%. Well, they started from 0%, the Fed, and went up to 5%. Okay, we haven't seen the effect of this. We haven't seen the effect of this in the stock market, and we haven't seen the effect of this in the real estate market. This creates a lot of problems, When you think about the debt, well, everybody's got debt, or Federal government, I just mentioned that, how it blew through 32 trillion on the way to 33 trillion, another 100 trillion in unfunded liabilities, which would be Social Security and Medicare. Where's that money coming from? Well, they're going to have to print money. When they print money, what happens to money? The value of your money goes down and it costs more to buy things. But the average person has a lot of debt. Let's just talk about some of that. Now, there's $1.7 trillion of student loans. Now, they haven't made payments in over 3 years on 1.7 trillion, but it starts in August. They're going to start making their payments again. Okay. Now, credit card debt is at a record high. We've never been over $1 trillion in credit card debt. Now, why is it so high? It's high because people don't have money, right? People don't have money to buy groceries, so they use their credit card. People don't have money to pay for the spare tire when you get a flat tire. They use their credit card. They don't have money saved. They're flat broke. They have a credit card. So credit cards are now over $1 trillion. Average payment on a credit card interest rate wise is about 22%. 22% on $1 trillion just is sucking billions of dollars out of the consumer. Okay, so we got the student loans, we got the credit cards. The other big one is the auto loans. Auto loans over $1.5 trillion. Now, this is the first time ever that a lot of these auto loans, well, they have negative equity on auto loans. Their loan is worth more than their car is. They have nothing in their car. They have to keep making the payment, and they hope and pray their car doesn't break down because they can't get another car. They're upside down on this car. So you have all of this debt, and you have this lag effect going. You see, the government raised all those interest rates now up to about 7% on the mortgages. So all these people that are locked in at 2.8%, they have no way to tap the equity in their home. They have no way to get the money out, right? Because the rates went up. Now, in the old days, which was just a couple years ago, all you do is you go refinance, pull out the cash, and then you're good. You keep living another 2, 3, 4 years, then you go do it again. Well, okay, but right now, that's not working. Why is it not working? Well, because they're locked in at 2.8%, but they need money. They're struggling. They can't make their payments. They can't pay their mortgage. They need to get money from somewhere. What is their choices? Credit cards, 22%, right? And a lot of these people, they don't have equity anymore because the house prices have started to come down. Look, things are changing, and they're changing really quickly, and people don't notice the change. It's called the lag effect. This lag effect is going to come, and it's going to chop real estate prices probably 40% down from here. We're already down about 10%, but it's going to chop them lower because there's going to be what's called forced selling. Forced selling, when people have to make that choice. They have no money. They can't refinance. They can't even get a HELOC because there's no equity. And once they start losing jobs, this is going to get ugly really fast. But there's no shortage of homes. There's no shortage of inventory. 16 million vacant. Investors are holding on to 22 million. 40 million retired people that are going to have to make a decision of how they're going to get money for their retirement. Their retirement is in their house. They're going to be selling their houses. They're going to be dumping these on the marketplace. New home builders, that's coming onto the marketplace. 1.6 million of these homes are coming onto the marketplace this year. So the inventory's there, and you're going to start to see it coming on once the forced selling starts to take place. Now, I know. But Mike, there's no forced selling in my area. Everybody has a job. And that's great. That's great. We love that, right? Everybody in your area has a job. They're never going to have forced selling in your area. But most areas, people can't make their payment. People that bought their house in the last year, 80% are struggling to make their mortgage payment. The buyer's remorse is running off the chart. You go out and buy a house right now, I'm telling you, you're going to have buyer's remorse. People say I'm just negative. I'm just telling you this so that I can get the listing when you sell your house. you can go out and buy a house right now. I'm more than happy to sell you one, but it's not a good time. I love real estate. Real estate is a great opportunity, a great investment vehicle, but there's time to be very cautious, and that time is right now. Prices are high, rates are high. Nothing's adjusted yet. Nothing has adjusted since we went from 0% to 5% interest, and nothing's changed. It's starting to change. It's called the lag effect. It takes about 12 to 18 months for that to come into play. And when we get this recession that's coming, and believe me, it'll be here. I don't know the exact timing of it. Nobody does. Maybe it's here by the end of the year. Maybe it's the first quarter of next year. I don't know, but there's going to be a lot of job losses. People are going to lose their jobs. They're going to be forced to put their homes onto the market, and this will bring the prices down. If you can be patient, sit back, watch the show, and watch it play out. It's playing out, and it's starting to play out now. It's just starting. The storm is finally coming. It's called higher interest rates. It's called the lag effect. The lag effect is catching up. This market is going to just be punched in the face, really. It's going to come down. You can take my word for it, or you cannot. This is just my opinion. A lot of people think this market's going to double from here. Like my friend that bought that house, 950 square feet he bought, 1.3 million. He thinks it's going to 2.5. I don't think so. Well, probably not in my lifetime. Anyways, if you like this stuff, give me the thumbs up. Why not? It's Tuesday, everybody. Get out there. Have a great day. Bye-bye now.